The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome back to the Monday night property edition of Your Money, Your Call. I'm Margaret Lomax. Thanks for keeping Michael company while I was away, and I hope you all had a great show. In news this week, it's the try before you buy deal that promises more than just a sample. Prospective home buyers are being given the chance to live in the fully furnished unit of their dreams before buying it. The daring sales pitch comes from a developer in Queensland amid a slow property market where house hunters are holding off because they can't sell their existing home. Under the try before you buy option, you can live in the new place for a nominal fee while your house is on the market, with the option of moving back out if it doesn't sell. The concept is considered a risk for developers who usually steer clear of subject sale contracts. It's aimed at downsizers who are trying to offload their houses, with the key condition being that it is limited to genuine buyers and is valid for just 60 days. And according to a survey by consultants BDRC Jones McDonald, half of all property investors hand over the entire management of their rental properties to an estate agent. The survey concluded that these landlords are better informed and have more profitable investments as a result. Overall, more than 77% of landlords involve a property manager in some aspect of their rental portfolio and tenant management, with less than a quarter self-managing their investments and tenants. Around 12% of landlords surveyed said that they used a property manager just to collect the rent. On average, landlords that use a property manager are better informed of the return they're getting from their investments than those who self-manage their investments, though in both cases a high proportion of property investors have no idea of the rental yield their properties are achieving. With me tonight to help me answer your questions and to discuss these stories is Brad Beer from BMT and Ben Kingsley from Empower Well. And so whatever your question is about investing in property, I have the experts here to answer them. Now, if you do want to chat to us, my advice is to get in early and call now to join the queue. The number is 1300 30 34 35, or of course you can email us at property@skynews.com.au. And welcome to tonight's program. And welcome to you both.
Thanks, Margaret.
Ben, let's start with you. Try before you buy. Who is it riskier for, the developer or the actual person who's doing it?
Looking at the target audience that they were trying to promote to, which is basically the downsizer audience, look, if they've got no other, tricks in their hat, this might be the one that might work for them. I mean, from an investor's point of view, it's obviously a no-go zone, but for owner-occupiers who are looking to downsize from maybe a larger property they've got on the Sunshine Coast, where this experiment is taking place, it might just work for them, and there will be a lot of people who want less maintenance around their house. So, if nothing else is working for them in the soft market, I don't see any harm in trying.
I guess, Ben, in this particular instance, it did look like it was fairly genuine and legitimate. Reading the article, the developer said, well, if it doesn't work out, you can just move back out again. But people who are buying properties like this do need to be careful of other incentives, because often there are catches in them.
There are lots of incentives, Margaret, that developers and builders try and put in there. Rebates are a big thing at the moment for house and land packages where the market's struggling. So I think as long as, the consumer understands what they're actually buying. I mean, a lot of the time in our business, we're actually trying to explain for people if the property's worth $315,000 and there's a $15,000 rebate, it's a $300,000 house and land package. It's not a $315,000, value. And I think that's really important for consumers to be aware of. I mean, they need to understand that that's the market value. They're not actually getting a $315,000 house and land.
And of course, the other thing about that is if there is a $15,000 rebate, it must be in the contract, and if it's in the contract, the bank will then only give you 80% of the 300, not the 315.
That's right, and let's be very clear about why they're trying to do this. They're basically trying to show that through the Lands Transfers Titles Office that the actual value of the house went through at 315, or the transaction went through. So for any further developments in the stages of developments that might be taking place in these areas. So it's very, very dicey, and it's certainly something that we say to our clients, get it in writing, get it taken off the value of the property, because that's where the comfort lives, because the value will find it, and they'll make sure that they'll take the rebate off.
Absolutely. And of course it's against the law to not disclose the rebate, and you know, I remember about 10 or 15 years ago there were a lot of these rebates coming through. They weren't disclosed in the contract. If the banks later found out about them and you hadn't disclosed it, you could actually be guilty of mortgage fraud.
Well, that's right. I think from a mortgage broker's point of view, they should be providing both the contract of sale and any other supporting contractual documents. I think what we're finding is more and more of the times they're not actually doing that. They're basically just passing on just the contract of sale, trying to avoid that. And I think that's been cleaned up over the last 4 to 5 years.
Absolutely. Brad, let's talk about property management. And I must admit that I was probably a little stunned to find the number of people who actually choose to self-manage.
Yeah, I've actually seen some numbers on that in the past, and look, I'm a firm believer in the property manager. I don't want to have a relationship with all my tenants, especially if there's a problem, and that's really a large percentage of that, of the reason why I use them. But it's also about they're sitting there every day playing in every market with what's renting and what a market rent is for that property, and I think that therefore they should be able to get it at the market rent. No matter, because you know, I'm not sitting there renting properties in the market of every one I own all the time, not trying to rent them myself, not trying to rent them out myself, and I'd probably end up with losing a large amount of rent that I could otherwise have got, much less than the management fee that they normally charge, which is usually fairly nominal. I think also the education that they're able to provide. I do a lot of training to property managers on depreciation and the importance of. Now, they don't always get it, but some of them do. They've got the opportunity to make sure that some of the things like depreciation are covered, making sure your insurance is in place properly, and things like your smoke alarms are done properly, leaving that onus with them to make sure the things that need to be done are done, to take the risk away from yourself as well.
Yeah, I must admit, a lot of my property managers send me newsletters and emails and little bits and pieces that I think, well, you know, of course I know all this stuff, but if you didn't know it, at least they're staying on top of it, and they're certainly helping me to stay on top of all the claims I can make and all the things that I'm allowed to do, which you wouldn't get if you're trying to rent it out on your own.
You wouldn't be able to find those things. They're put there. We sometimes provide them, but it comes out with, you know, articles about, you know, you should save money on your tax by making sure you claim all the right things. Please ask your accountant.
Yeah, and you know, the other thing too is I find that people really underestimate the value of their own time. If you work out what it actually takes in a week in order to really properly look after your property the way a property manager would, I'd venture that the after-tax $15 that you spend on your property manager is well worth it, because it's going to take you more than an hour, at least more than an hour a week. Probably more like 2 if you added it all up. If you took those times when it's going to take you 7 hours because you're sorting out a problem and averaged it over the year, I know that my time's worth more than $15 an hour. I'd much rather pay someone else.
Absolutely.
But people just don't see that. Look, let's go to the phones now. Victoria from New South Wales. You've got a question about investing in property?
That's correct, yes.
What can we do for you, Victoria?
Okay, thanks for taking my call. So my question is, we currently own our home in Wollongong, and we own the property next door as an investment property, and do also own an investment property across the road. Now, the house for sale has also come up next to the house that we own across the road. It is a corner block. We're sort of umming and ahhing whether we, you know, look at buying that property. Is it maybe over-investing, in our street? Do we look somewhere else? So basically, yeah, are we doing the right thing?
Victoria, it sounds to me like you're trying to own the whole street there.
Yeah, well.
Have you got any particular plans for the street once you own it all?
No plans at all. So it's just maybe a long-term investment. I am 38 years old and my husband's 45. It is a very rundown type of a house. So a lot of work needs to be put into that. So my question is it really over-investing in a particular area, being in Wollongong? Should we really look at investing somewhere else?
Okay, it's a good question. And Ben, how would you advise Victoria?
Hi Victoria, thanks for calling in. Victoria, the big thing for me is what will that land do in terms of once you combine the two together, how much land will you have available? Because what you're effectively trying to do by owning a property next door to one that you already own is to potentially land bank to see what sort of development may be available in the area. But it's really important to understand the demand for the types of properties. So you might have a whole street available to you and you may buy that street, but the demand for units or townhouses in that area may not be strong. So you need to do your research around what it is in terms of the value you're going to be able to get by owning this particular property. If you and your husband are handy and this is a rundown property and you think you're getting it below market value and you can improve the value of the property, it may be worth considering, but there needs to be some number crunching around that. From a development point of view, because technically there's the only advantage in terms of turning 2 sites into a 4-site or a 6-site development, that's where you're going to see the upside. So if that's not what you're planning to do, or if you're not planning to get permits for that, then you're not going to realise the value in actually doing that. So diversification could be something that I'd be considering if that's not what your future plans are.
So Brad, if we assume that Victoria wasn't interested in developing in this way and she was just simply picking them up because, you know, they're across the road and she can keep an eye on them, what do you think, is there a wisdom in what Victoria's doing?
Look, keeping an eye on is something that probably I wouldn't try to do. I've got properties that I probably drive past regularly and then you end up going, that lawn's not mowed and things like that. And in your situation, you're going to be across the road. You're living next to your tenants. I have a property manager there, so I don't actually, because I don't really want to deal with the tenants all the time necessarily, and you're going to have some sort of relationship because they're going to find you. This comes from someone who does have 2 houses in the same street, almost next door to each other as well. But that is because I'm about trying to developing those properties and doing something else with them. The diversification to more than just your street is probably not necessarily a bad idea, but it just is going to require a little bit more research. If you believe in that area and you think it's got a lot of positives going forward, then it's got some potential upside. But spreading it to potentially elsewhere where you can see, look, finding some other markets that you can also play in is probably not such a bad idea given the number you're owning in the street.
Look, Victoria, my perspective is along similar lines. I don't have a big problem with Wollongong, although it's by no means on the top or even on my hotspot list. So I'm not expecting that it's going to do anything major in the coming 3 to 5 years. And the biggest problem you have when you own all of your properties in the one area is that if it is an area that does suddenly become subject to a good amount of growth, and that's fantastic because you now have 4 times the opportunity to access that growth. But if your area goes through a period of stagnation, as I think Wollongong will, and even after it grows again, I believe it'll go through another period of stagnation, everything you own is in that stagnation period at the same time. And that prevents you from then leveraging further, particularly if you're mortgaged fairly highly on those properties. You want property equity to grow for you so that you can leverage back against that equity into more investing. And when instead you own 4 properties in 4 different markets, those markets may be performing differently than each other at different times. And as you grow your portfolio, owning them all over the place means that at any one time, something in your portfolio is most likely growing. I find that in my own portfolio, I have a lot of property there all over Australia, and at any one time, a couple of them will be growing while a couple of them are stagnating. So I'm more concerned about your exposure to the one market in those downtimes, which you absolutely will have, and how that may prevent you from leverage again. I'm all for diversification, and I'm for you actually looking for somewhere else to buy your next investment property. Well, thanks for the questions so far. Don't forget that each week the panel and I will choose one viewer to receive a copy of one of my books. In order to be in the running to receive one, you have to ask a question, and then you must be chosen by the panel as the question of the week. Now, the book this week is the 20 Must Ask Questions, and you can be in the running simply by calling us on 1330 3435 or emailing us on property@skynews.com.au. We have to take a short break, but stay with us. After the break, we'll be answering another email and, of course, taking your calls. We'll be right back. Welcome back to Monday Night Property. Of course, this is Your Money, Your Call, and we'll be doing our best to answer all of your property investing questions. Now, helping me to do that tonight is Brad Beer from BMT and Ben Kingsley from Empower Wealth, and we'd love to take your calls. So don't wait, pick up your phone and call us with any questions about property investing. The number is 1300 30 34 35, or of course you can email us on property@skynews.com.au. And Joanne from New South Wales, you've got a question about buying near Brisbane.
Yes, hi Margaret. Hi the panel. I'm actually watching your program weekly, and I know you've been mentioning the western corridor of Brisbane, Redbank Plains and Springfield Lakes.
Yes.
I've been doing a bit of research around the area, and I've noticed there's a lot of new housing estates. So I guess my main question is that I know you said, there'll be a lot of people moving to that area, but is there sort of too much oversupply at the moment in that area? And the other question is, we are thinking of purchasing a new house, so I guess less than 6 years old for the depreciation benefits. So, I'm thinking if there's an oversupply, is that sort of too much choice for the tenants when they're looking to rent a house?
Okay. All right, well, look, let's start with the question about the area for investing and what the oversupply is going to do. With you, Ben.
Certainly, Margaret. Thanks for the call, Joanne. You mentioned two critical things, oversupply and vacancy rates. They're obviously very important. When we talk about growing areas and new estates going through, we're not necessarily advocating that we like the new stock that's going into the market. We may be talking about the older stock that's in that particular market and getting that buying price right where it's affordable for the masses. In terms of how you work out an oversupply situation, the research I want you to look at doing is to look at to talk to the developers and see how many lots they're planning to release in that particular area, and then also have a look at the overall supply. So use a realestate.com or a domain.com and put in the suburbs, and you'll see the number of available houses available for sale or units, and then you can do the calibration by also then looking at the number of rental properties that are available as well. So then you can see what sort of demand drivers. From a very broad point of view, there's some good initial research that I'd be doing.
And Brad, of course, some good depreciation on a brand new property.
Yeah, definitely. Depreciation has a relationship to the construction cost of property and the value of items within the property. So, Joanne, the newer the property, generally the more it costs to build, and therefore generally the more depreciation. It's always a relationship to how much construction you're buying, I suppose you could say. So new properties, or you're looking at something that's about 6 years old, it's still got very substantial deductions, a little bit less than a new one, but not not zero. Anything you buy has some depreciation. There's some important dates. 1987 is one of them that make a big difference to that. And if you're looking at anything that's after that, you've got to crunch numbers. But depreciation is only one part of the whole property investing scenario that you need a number for to crunch the whole thing and whether you can afford to own it.
And Joanne, I certainly like that area, the southwest corridor, out from Brisbane down through Springfield Lakes, down through Loganshire, and all the way out through Redbank Plains, Ipswich, and taking into Woomera as well. I wouldn't worry so much about there being oversupply. The councils are very aware of the needs of the community, and there's an expected very big swing in the population upwards in the coming 20 years. And we're going to see an incredible growth in that part of town. The other thing about the area is that you start to get down in that halfway mark down toward the Gold Coast. So it's kind of like, it's becoming like an economical hub that joins the Gold Coast to Brisbane, and there's an awful lot of business developing in the area. Lots of infill development happening too, and an awful lot of jobs being created in the area. So as far as oversupply, I'm not overly worried about it. One of the things that I will warn you though is I wouldn't be looking at one of those new house and land packages to buy, because what's been happening in that area is that a lot of the new house and land packages are coming on at about $40,000 and $50,000 more than it will cost you to get a 2 to 3 year old property that's not a new house and land package but still offers you almost the same rent, probably the same rent, and also very close to the same depreciation because it's only had 2 to 3 years off the top of it. I'd be more inclined to look to negotiate on one of those established properties than go for the new house and land packages. Always remember that you are paying that developer profit when you buy a new house and land, but when you're buying established from someone else, you're not doing that. So be careful what you buy. Make sure you research the market very well to work out what kind of property the demographics are demanding in terms of an occupancy point of view, and you'll certainly limit the risk of you having one of those properties that is oversupplied and therefore you can't get a tenant for. Well, this week Mark wrote to ask a question about interest-only loans, and he writes, "Hi Margaret, I have 3 investment properties and I'm paying interest and principal on the first property, which I purchased 2 years ago, but interest only on the other 2 purchased in the last 12 months. I feel as though I'll never get to own them because I'm 50 years old. I work in the mining industry and I pay a lot of tax, hence why I've invested in property. Should I be paying down the principal on the other 2 properties as well, or just be expecting to reap long-term capital gain from them? All properties are rented out at around market value rent with good long-term tenants." Okay, Ben.
Look, good.
The big question.
A good question, Mark. It really is. Look, traditionally, I would say interest only is the way to go, and that's the broad statement. But what I don't like to see is interest being paid on debt if there's no payable means to pay down that debt. So what I'm saying there is you can potentially set an offset account up and accumulate the value of that money in the offset, which is then paying down that debt. Even though it may technically not be in the loan account, it's still paying down that debt. So for me, I still believe you can retire that debt because as the value of the asset continues to grow, the rental increases will continue to grow, and at some point in time those properties will be turned positively geared. But you can add to that, Mark, by actually paying down that money. Whether you have principal interest loans or interest only is technically irrelevant, as long as you can focus on either paying up that offset account or also paying the money off from the loan.
Brad, what's your preference?
Look, I'm a firm believer in the interest only for very similar reasons. Once you start paying principal, if you do actually want flexibility to use the money as the next deposit for the next property or whatever it is you want to do that, you've got to go and ask the bank for it back. If you've put it into, which I always use, an offset account or some sort of redraw facility, then you don't necessarily have to go and reassess your loan to see whether the LVR is still right and get some of the money back. The thing I'll say about that, though, is you need to be very controlled with your money and make sure someone has a handle on whether you take money out and spend it on things that you shouldn't. And if you are not one of those people that controls that, then you should not have an interest-only and offset account. You should give it to the bank and make sure they're not going to be able to give it back to you unless you really need it for something that someone else has to say yes for.
So no redraw either. Mark, this is how I want you to consider your property portfolio from here on in, and that is as a property portfolio. So you have one property portfolio, and against that you have an amount of debt. However that's structured, whether it be in 3 loans or 1, it's an amount of debt. It doesn't really matter where you repay that debt, so long as the debt is being repaid in some way, either by directly paying into that loan or one of the loans first, or by setting up an offset account so you have the same net effect, which is the amount of money you have sitting in offset is equal then to the amount, that's like the amount that you've paid off the debt, and you won't pay interest on that amount. My biggest concern is that people don't see that, and so what they're thinking is that they should be paying a little bit across all loans. It doesn't make any difference. At the end of the day, your net worth is your net worth, even if it's 10 or 20 loans and 10 or 20 properties. The property value less whatever the total debt is what you're worth, and you're looking to improve what you're worth through 2 things: debt repayment and market growth. You're earning good income at the moment, and I'd like to see you funneling as much of that as you can into debt repayment. So during these times when we're not getting as good a growth as we might be able to, you're still buying equity, so that enables you to leverage again. When you go to the bank to find out whether you get any more money, they'll consider all the properties together and how much equity you've got to lend against that for the next property anyway. Probably need to have a good chat to somebody who knows how these things work, so they can first of all make sure that your structure is correct, and secondly advise you on whether you're the kind of person who should be paying off the principal or whether you're safe to save your money in an interest offset account. But don't forget that the bottom line still remains the same. Mei Ling, welcome to the program.
Oh, good evening. Thank you for taking my call.
You're welcome.
My son is thinking of renting out his apartment.
Yes.
And before he does that, he's thinking of replacing the old stove, and also thinking of putting in a new kitchen benchtop.
Okay.
My question is, can he claim back the cost of putting in the new stove and also replacing the kitchen benchtop?
Okay. Now, Mei Ling, first of all, congratulations for ringing before you went and did this, because a lot of people don't do that. And they call up after they've done it, and then they find out that they might have done things differently. And I'm pretty sure that Brad B is going to tell you exactly that. Brad.
Look, May, I speak to those people on a regular basis that do that. I replace all those things. If you replace it while it's a principal, I assume he's living in the property, a principal place of residence, there's no tax claims in relation to anything. The only thing that'll happen then is this new stove and benchtop will go in, it'll start depreciating. When he does move out of there, he'll have a situation where he can make some depreciation claim, which is fairly small. When the property is operating as an investment property, then the whole thing happens a little bit differently. Now, if they're really bad and they need replacing, you're going to have to replace them because you've probably got the opportunity to get potentially better tenants and better rent for it. But if they're not, leave them there for a while, rent it out for a while. When you decide to replace these things at a later date, you'll have some writing off or scrapping of potentially of some of these things that were there to be thrown away and start depreciating those new ones. So usually most of the time it's better to do it actually well after you've actually rented the property out and made it an investment property.
So, Brad, let's just quickly talk this through for Mei Ling. She is best, providing they're in good enough repair to still get a tenant, she's best to get a tenant in and maybe even say to them, look, after you've been in for a little while, I'll change these things over for you. Let's face it, it's a stove and a bench top, it's a one-day job, it's not going to really put the tenant out. Get the tenant in there, and either while the tenant's in there or when you're between tenants and still available for rent, then replace those things.
Yeah, anything that needs doing you've got to do, and if it's going to make enough difference that you're really, and a bench top and a stove, like if the stove's cooking food, a bench top and a stove is going to make a very big difference to, or the things that you are going to do, whatever they are going to make a very big difference to what sort of rent you're going to get for that property, or if you're looking for a valuation, then you maybe do it, but leave them between tenancies is a great time to go, what do I need to do to make this to the next level? And there's definitely some better things from your tax that you can do that.
And again, to clarify, what will happen for Mei Ling's son is that not only will he be able to claim depreciation on the new items that he's going to get in, but he will also be able to claim the loss in value or the scrapped value of whatever's in there. And there won't be a lot, but there'll be a bit of value there to throw out.
Look, better than nothing. And look, you don't have to spend the money till later either, I suppose.
Yes.
You know, why spend it now when you've probably got a lot of costs moving somewhere else? If you can spend it after a tenant's moved out in 12 months' time, it might be better.
Okay, excellent. So hopefully, Mei Ling, that helps you out a little bit. If you can wait for that, then tell your son by all means, just wait that little bit of time, even if it's only a month or two, and then carry out that for a fully tax-deductible repair. But if it looks like it means you'll get less rent or you have difficulty renting it out because of the condition, get it done now and get that little bit of extra rent in your hand weekly right from the beginning of the tenancy. Well, there's still plenty of time left, and if you have a question for anyone on the panel, remember that you can be in the running to receive my book, The 20 Must-Ask Questions for Every Property Investor. Now, to do so, all you have to do is ask us the question of the week. You can do this by giving us a call on 1300 30 34 35 or emailing us at property@skynews.com.au. We're off for a break, but don't go away. We'll be right back to answer more of your questions. I'll see you soon. Thanks for staying with us. You're watching the property edition of Your Money, Your Call. But this evening we're answering all of your property investing questions. Tonight you'll be speaking with Brad Beer from BMT and Ben Kingsley from Empower Wealth. And of course I can also answer any property investing question that you might have. So call us now on 1300 30 34 35 or you can email us on property@skynews.com.au. Now whenever Brad's on, the panel and I get together depreciation questions, and this week Luke from Picnic Point asks, Hi Margaret, I have a question for the Your Money Your Call panel about depreciation scrapping for a carport and awning at my investment property. I've already obtained a depreciation report which lists both of these items. They were both built exactly 20 years ago and have 20 years of depreciation left. If I demolish the carport and awning, am I able to claim the remaining 20 years of depreciation as a tax deduction? We were just talking about scrapping. How is it going to apply for Luke?
Yeah, it's a very good question, Luke. And the fact is they are listed there. And if you do knock them over, providing they're after a certain date, which is the 26th and 27th of February 1992, which is just around 20 years, providing they commence construction after that date, you'll be claiming this building allowance on them. Now, they're on your depreciation schedule, so I'd assume that means you're able to claim this. Now, if you stop making income and demolish these things, the residual value of these items should be scrappable in the year that you actually rip them out and throw them away. So it's half the value that's pretty much left. If you've got 20 years of it used and 20 years left, it'll be an instant deduction in that year that you actually rip them out. So very easy to calculate what that is based on residual value that report should put out or show you based on what's been in there. So that's a great situation.
You know, a lot of people really don't understand this whole scrapping thing, and I know people really miss a lot of valuable deductions because of it. And, you know, just for the benefit of all the viewers who are tuning in tonight, basically, if you want to do anything at all to your property that is income producing, don't do it until you talk to a quantity surveyor. That's probably the best advice.
I do a lot of training to investors and you know, the real estate industry on depreciation, and a big part of it's like one thing to take away is if you're a renovator, just call the quantity surveyor first and ask about scrapping and ask about what's there, because you're throwing away things that have value. When you throw away things that have value, you're quite possibly able to make a deduction for the rest of that value. Now, it's better than depreciating them over the next 5, 10 or 15 years, because it's an instant deduction in that year. We'll always, like, number one thing almost if you're a renovator is always just call first, work out whether there's anything you can actually claim for what's there, as opposed to doing it after the fact and just thinking about the new things you get to depreciate. Yeah, there's some adjustments after, but what's there you can no longer see. I want to see it before it goes away and gets thrown away. So if you ever do get audited, we've seen it, we've photoed it, it's part of the house, and you've made a deduction for them in the year that you actually threw them away.
And it can be quite lucrative as well, so it's certainly worthwhile taking the time to get that quantity surveyor out. Venkat from Melbourne, you've got a question about bank loans.
Yes, please. Thanks for picking up my call. I live in Melbourne and I'm investing in a property in Queensland near the mining area. Basically, I'm an Australian citizen and the whole family, we are migrating back to our home country. So is it possible to obtain a bank loan in such scenarios? Okay.
Venkat, can you tell me at the moment, did you say you were an Australian citizen?
Yes,
or just
yes, please.
You are an Australian citizen?
Yes, please.
Okay, I guess technically he can get that loan before he goes then, Ben. Being an Australian citizen, expats can get them when they're away?
Yeah, Margaret, there's a couple of things, Venkat, we need to understand. Firstly, when you migrate back to your original home country, are you going to have an income? Because there's a responsible lending test that's required in terms of any new lending that takes place, which effectively means, do you have an income to be able to service that loan? If you don't have that income, then technically anyone who's providing you with that loan is in breach of the NCCP guidelines about responsible lending. If you're getting a transfer, say, to your current company and transferring back to another country, and you're an Australian citizen and the security's in Australia, then lenders will look at people who are basically Australian residents who are living offshore. So it's all going to come down to the level of income that you've got coming in to see whether a bank is going to provide you with a loan or not.
But, you know, it's very similar to someone an Australian born and bred who goes overseas,
it's exactly
providing they've got an income. Being an Australian citizen means that they can actually get a loan here. So.
Yeah, there's around sort of 30-odd countries that lenders in Australia are very happy to do loans for. They understand the economies, they understand the political stability of those countries, and they then correlate that income into Australian dollars to work out what sort of borrowing power. So obviously the major ones are the US, the Canadian, the UK, but of course there's the Indians, there's the Thai baht. Those type of currencies are also accepted by most of the lenders.
So that's good news for you then. Well, we often talk about off-the-plan investing, and this week Vivek asks, Hi panel, I've booked an off-the-plan 2-bedroom, 2-bathroom apartment in the Melbourne Star apartment being constructed at Little Lonsdale Street, very close to Melbourne Central. It doesn't have a car space. Do you think it's a good long-term investment, or should I get rid of it and invest somewhere else? This is an investment property. I might just kick this one off with you, Brad, because I know Ben's from Melbourne. We'll come back and see how he feels about it. It's a 2-bedroom, 2-bathroom off the plan. He didn't say, but it may or may not be a serviced apartment as well. I mean, it's right there in the centre of Melbourne.
Yeah, and I had a bit of a look, because this was an email question, obviously, and I think the car parks are actually for sale for an additional amount of money.
Okay.
And I think, you know, I don't know the exact prices, $150,000, and I'm not sure of the actual price of a car park in Melbourne, what's it worth, which Ben might help with. My thoughts around no car parks are, generally I'm probably one who likes a car park, but I'm a guy who likes my cars, I suppose, and I like to drive, but I'm also not everybody. It's proximity to where people need to get to, or proximity to transport, to trains, to everything that needs to get around, and the demographic of the people that you're actually looking to put in there as tenants is just things that you need to do some research on. Now, being a 2-bedroom apartment with 2 bathrooms, I think it was, then it's, you know, I think you often see no car spaces on probably smaller units, 1-bedders, bed-sitters, because it's more likely to be one that's probably used by some more transient people. So it seems a bit odd for a 2-bedder not have that. But if the numbers say that people don't have cars in your area, then maybe it's not such a problem. Some people are going to have cars, and you're widening out to more people that you're able to sell that investment to in the future if you do actually have a car space, in case, like, without a car space, you're selling to someone who doesn't want a car space. With a car space, you could be selling to either, but you might be selling it for less. So it's got a bit more research on the actual demographic of the area and what they actually want, I suppose, is what you need to look at.
Okay. Now, Ben, you're probably familiar with the development, and you're also familiar with the Melbourne market at the moment. Would you be buying an apartment in Melbourne at the moment?
Look, I wouldn't be buying an apartment in the CBD. One of the big missing pieces of this jigsaw puzzle for us is, what is the value that you're paying for this? So, of course, like Brad, we had a look at the development, and we can only assume that you've picked it up at the advertised price, as opposed to, you know, negotiating a significant discount to value. So, assuming all of that, and assuming the amount of apartments that are coming online in the Melbourne CBD area, I think your money could be better spent elsewhere. So the way I'm looking at this one is, you've said you've booked it in, so you may have a holding deposit on that. I would seriously consider your options outside of the Melbourne CBD market at the current moment.
Yeah, look, Vivek, I tend to support what both of the boys have said tonight. If I was an owner-occupier, or you were an owner-occupier, the advice might be quite different, because I think when you're an owner-occupier, we pay extra, or we don't worry so much about the capital growth in order to get the lifestyle things that we need. There's certainly something to be said about that really inner urban living, living in the city. Clearly they have no car space, because I think if you're in the city you're not going to need a car to go anywhere, although that assumes that you have no friends outside of the city. And so as an owner-occupier, the advice might be different. As a pure investment, do I think that apartments in the CBD of Melbourne are the best investment you can buy at this point in time? No, I don't. I think there are far better markets, first of all out in the suburbs of Melbourne, but then probably right away from Melbourne altogether, because Melbourne has not only become a little overheated since the GFC, they've certainly had a market that ran away just after the GFC and is only just starting to plateau out in the last 12 months. But it's just not the time at the moment to be buying apartments in an area where there's a big supply of apartments coming. Got lots happening in the CBD of Melbourne, and I think as for an investment, you might be waiting a little bit of time before capital growth happens. Of course, you do need to go and talk to an independent qualified property investment advisor who's not related to the development, who can give you some advice that relates to your personal circumstances, just to see whether or not it is right for you or not. Damien from New South Wales, you've got a question about buying a property.
I have, yeah. Thanks for taking my call, Margaret.
What can we do for you?
The question I've got tonight is, I've got $200,000 to spend, and I'm looking for a potential high-growth area, like short to medium term. So I'm just wondering what each person in the panel thinks tonight about the best area to buy for $200,000 anywhere in Australia.
Okay, now Damien, is that $200,000 a loan or is it cash or...?
It's a loan.
It's a loan, okay. It's important for us to know that because, of course, we can't tell Damien what to do with his cash.
No, we can't.
But interestingly enough, we can tell him what to do with as much money as he can borrow, which is a little bit of an anomaly and certainly a big gap or a gaping hole in the regulatory regime in this country. But Ben, $200,000, low buy-in price, but there are some opportunities out there for Damien.
There are some opportunities. So, Damien, you've given us pretty much a market that's got 9.1 million properties available, if you're talking about the broader market. In the 200,000 range, what I'm actually... areas that we like, that we're quite bullish on at the moment, is some of the entry-level one-bedroom apartments around the city fringes of Brisbane. We're looking at and running our ruler over a couple of those areas. In some of the regional areas, there's no mistaking that we're bullish as a business on the Ballarat region. The Ballarat region will actually give you an entry-level 2 to 3 bedroom house in that location within close proximity to the transport and the central business district of Ballarat. So they're two areas that we would consider money well spent.
Okay, Brad, where would you spend $200,000 at the moment?
Look, I've been looking a little bit at property at the moment and thinking where to buy myself. So that's an interesting question, and I guess I was in my mind thinking, you probably got to get into a unit or something in that Brisbane or that Logan Shire area that, Margaret, you were saying you've got some belief in at the moment. If you think there's belief for growth, you're probably able to get into some of that market for that sort of dollars, and I'd probably think about there.
Absolutely. Look, Damien, I'm going to go right out and tell you exactly where I think you could invest. First of all, the early 200s, and hopefully you can stretch up to maybe around 210, 215, is going to buy you some really good property down in the Onkaparinga Shire in South Australia. I know I've been talking about that like a bit of a broken record, but it's some really good buying and some great returns at the moment with rents up to $300 a week. So you've got some really nice cash flows happening there. A lot of the properties are a little bit renovated as well, so you've got some depreciation too. So you come pretty close to positive cash flow, if not a good positive cash flow, depending on the level of your own income at the present time. I'm liking the Lower Hunter around Cessnock. I think you can get some pretty good properties there. And the thing I like about those ones is there's a lot of them with big blocks of land that you could potentially develop immediately with a granny flat addition and almost double your rental return on them. $200,000 will buy you a property that probably rents for about $260 to $280 a week. Then a granny flat would probably rent for another $200 to $220, maybe cost you about $100,000 to build. So there's another good option. Finally, yes, the Logan Shire, as both of the boys have mentioned, is an area that I'm a fan of. You can buy in there probably a 3-bedroom townhouse for around the $200,000 mark. You'll be looking at somewhere around the $280 to $320 a week rent return on that one as well. So there's a good place for you to start. Drop us a line and let us know how you go with all of those. The questions have been really good so far this evening. Keep them coming. And remember that our question of the week, chosen by the panel, will receive a copy of my book, The 20 Must-Ask Questions for Every Property Investor. To be in the running, send us a question or call us on 1300 30 34 35. It's time again for another short break, but we will be back. The email address to email us a question is property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and with me on the panel tonight is Brad Beer from BMT and Ben Kingsley from Empower Well. There's still some time left for you to call and ask us any question about property, perhaps be in the running to receive the book, The 20 Must-Ask Questions for Every Property Investor. The number is 1300 30 34 35, or you can email us your question on property@skynews.com.au. And Gary from Victoria, welcome to the program.
Thanks, Margaret. Thanks for taking my call, and hi to the panel and you. I've got two questions. I've got a rental property in Victoria, and in relation to the first question, I've got a tenant that's moved in the recent past, and there's obviously some issue with them getting gas connected to the property, and it was a result of the previous tenant, and the gas suppliers obviously put some sort of black ban on the property, so it took the current tenant a few weeks to get gas connected. So I've never lived in the property never had any utilities connected to the property in my name, all that sort of stuff. So last week, the tenant slapped a VCAT tribunal thing on me, and I'm just wondering, you know, realistically, whether or not there's a claim to it, because I think there's a claim to it, but it's not against me. It's perhaps against the gas company, or, you know, should be taken up with the ombudsman or something. But whether or not I should, you know, take my time out and go and appeal it and present myself at the VCAT and all those sorts of things. The second question is just a maintenance question. That same tenant, in the property, there's a gas cooktop and, you know, freestanding stove. The ignition in the oven, the ignition clicker thing, seems to have failed. And so I had a gas plumber go out there and have a look at it, and he said, oh no, it's just, given the age of the unit, it's just old, so we can't replace it. But I've given them a igniter thing, like a barbecue cigarette lighter thing to use it, to get it going. So I spoke to the property manager, and I said, you know, what are my obligations? Do I need to replace it and replace the unit, all that sort of stuff? And she said, well, I've got 10 landlords that would replace it, and I've got other landlords that wouldn't. It's up to you. And she's also included that on the VCAT action. So just your thoughts on that item in terms of repairs and what my obligations are.
Okay, you're probably a good one to go to for this one, Ben. Not that you've had a lot to do with VCAT, but certainly you do work pretty predominantly in Melbourne. So.
We do. Look, I think that the most important thing is, what is the claim, Gary? How much is she asking, you know, to settle this claim? If it's a significant amount of money, then by all means I'd be leaning on my property manager. They are the professional people that you have engaged to provide you with professional advice in this particular circumstance. If we're talking $100 or $80 claim for the delay in the gas being connected, then I would, as a goodwill gesture, if they've signed a lease, and this is my personal view, maybe look at just making it happen, you know, settling that particular thing and moving on. And that might be enough goodwill for the tenant to then say, well, you know what, that clicker that starts the gas fire the tops, then that might also sort things out. I don't like to start on a new tenancy where my tenants are unhappy about the product that I'm delivering to them. I want long-term tenants staying in my property for a long period of time. So just depending on how much that claim is will determine what sort of course of action. And obviously, again, leaning on my property manager to make sure that they're giving me the right advice in this particular point.
And they probably should have been doing that all the way along as well.
Agreed.
You know, like, I think that kind of thing comes down to a property manager. We retain them for a reason, and I'd be, you know, if it was me, I'd be inclined to be going to the property manager and saying, look, you know, we're going to split this one.
I don't pay you a professional fee just to collect the rent.
Exactly.
I pay you a professional fee to look after the property and take care of everything to do with it.
Exactly, and you know, depending on the circumstances around it, I reckon I'd be getting them to go halves with me. Brad, it's worthwhile mentioning that if he does decide to replace the whole thing and, you know, the new clicker,
scrap the old stove and start depreciating the new stove, but it does really come down to, I kind of agree with you guys on that. How much is the claim going to be? Is it worth it to start off on a really bad foot? I mean, the tenant's not happy. They're at VCAT already. And I often probably am one of those guys that just replaces it, usually, unless they're being really ridiculous, so that we don't end up at VCAT, because you're going to take your time out to go and fight that, and what's your time worth? Again, on the property manager or the boss of the agency to say, we need someone who knows the real rules. Where do I really sit?
Yeah. And look, I'm of the opinion that if VCAT said, right, you can lodge a claim, but you have to pay $200 or $250 to lodge the claim, and that's non-refundable unless you actually win and then it's included in your win, there'd probably be 80% less claims in VCAT. It's a little bit too accessible. People tend to stroll on into VCAT for just about anything these days. You know, I'm with the panel. Depending on how much you're talking about, I'd certainly maybe try and settle it. Maybe you can settle it by offering the new cooktop, and you get to depreciate it, you get to scrap it. Your bottom line might not be as bad as you think when you have a look at all of those things. So, yeah, Gary, I'd have a good long think about it, do some little rough bottom line numbers and see how you stack up. Colin from Sydney, you're going to be our last caller tonight. What can we do for you?
Yeah, lucky last. Good evening, Margaret. How are you?
Good, thanks.
Margaret, my question, I've got an investment property already in the suburb that I live, and in the new year I'm considering sort of looking for another investment property, but obviously to diversify I want to go outside of my area.
Yes.
And I was thinking about doing some training, like in regards to investment property and how to pick, good areas and things like that. So I was thinking about doing some training. Now, since I have an investment property already, would that training be considered, would I be able to claim that training as a tax deduction at all, do you know?
Now this is a good one, and I think I do know the answer to it, but Ben, I'm going to see what you say.
Look, I'm not a tax advisor. I've heard different outcomes from different types of education content. So I would be saying, I'd be obviously referring back to my tax advisor and saying, this is the course or this is the education I'm looking to do. Will that constitute research as part of the next acquisition that I'm making, or would it not?
Okay. But the point to make is even if it does constitute research as part of your next acquisition, you still can't claim it as a tax deduction, because you can only make claims for expenses that are incurred in the process of an income. And as you don't already own an income-producing property, then you can't actually claim those expenses as a tax deduction.
Would it be part of the capital base?
Well, whether or not it's part of the cost base, I think you'd be very lucky to get away with that. I don't think you're going to get that. Colin, you can do the course. You'll have accountants that will tell you that, yes, you can claim that as a tax deduction. I go with your accountant or your tax advisor, but I think you'll find that you probably can't, because it has to be directly related to a property. If the course was how to be a better landlord, then that might suffice. But if it's just training to help you buy the next property, you're unlikely to be able to claim that as a tax deduction. Just check with your advisor, and why not call the tax office and get a ruling on it? They'd be happy to do that for you before you go and spend the money. Well, we thought you were the last caller, Colin, but Brian from Perth, you've snuck in. Brian, you've only got 30 seconds. What's your question?
Okay, Margaret, I'll make it very quick. Margaret, I'm just looking for some advice on getting finance for my next property purchase.
Okay, what kind of advice are you after?
Could you recommend a good broker to use?
Oh, of course I could. And I know that Ben will as well, although he is in Perth, Ben.
Yes,
so
he is in Perth.
You probably can't help him.
Well, technically we can help anyone. We've got clients in China and different parts of the world. The most important thing is you have to be identified under the new NCCP guidelines. So we'd need to make sure that we'd be able to identify you to meet those guidelines. In terms of brokers, look, there's lists of top performing brokers that you can access. People who are award-winning brokers, there's plenty out there. Obviously, my business is a brokerage, Margaret's business is a brokerage. So there are plenty of good brokers out there, Brian.
Sure. And it's my show, so I'm going to give a plug to the Destiny branch at East Perth. So go online to destiny.com.au, have a look. And look, to be honest with you, if you also go to pippa.asn.au, you're going to find a PIPA member, Property Investment Professionals of Australia, in your area. Some of those I know are brokers too, and being PIPA members, it means that they do agree to abide by a code of conduct as well as all of their regulatory requirements. And so pop onto that website. You're going to see a really good list of people there who you can trust and go to, confident that we're also watching the shop for you as an association. PIPA is, of course, a not-for-profit association that both Ben and I sit on the board of and help to protect consumers. So both of those websites are probably a good place for you to start, Brian. Well, that brings us to the end of another show. Thanks so much for joining us, and thanks also to my wonderful guests, Brad Beer from BMT and Ben Kingsley from Empower Wealth, not to be confused with Ben Kingsley from the movies. Next week will be another great show. Joining me will be Tony Hayek from Blue Wealth and Noel Petrahilos. He is also from BMT, a whole new perspective on depreciation. Now, the lucky viewer to receive my book of the week this week is Damien. Now, Damien, you called and asked the question about having $200,000 to invest and wanted to know if we had some ideas where to invest it. And I think this book is going to be just perfect for you, helping you to choose the next best area. All you have to do is email me at yourmoneyyourcall@destiny.com.au. There it is on your screen. Yourmoneyyourcall@destiny.com.au. and I'll send you that book. Now remember, the book is just for the lucky viewer who asked our question of the week. But if you'd like a book, you can get them from all good bookstores or from my online store at destiny.com.au. You can follow me on Twitter, Margaret Lomas AU, and also on Facebook. And if you'd like to get my monthly free newsletter, go to my website destiny.com.au, where you can register as a VIP and also find out how we can help you to invest in property in 2013. Finally, this week on Property Success, we're bringing some great Season 4 highlights, including the continuing journey of our Property Success investors. That's all day Saturday, starting at 9 a.m. I'm Margaret Lomas. Have a great week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.